U.S.-China trade tensions and the boom in artificial intelligence development have been the two dominant market themes this year. So what should investors expect heading into 2026? Joining us now to discuss, Kevin Hebner, global market strategist with TD Epic. Kevin, great to have you back on the show.
Great. Thanks, Greg.
Lots to talk about. It's been quite a year. China challenging the U.S. this year. Those tensions, you think tensions perhaps could be a bit lower next year? How could it all play out?
So we had two times this year where there's an escalation of the tensions. In April, after Liberation Day, where Trump announced his tariffs across the globe. And then in October, as Trump tightened export controls on advanced chips, and then China responded with rare earth export controls, or the threat of, and I think those are very important events. But going into 2026, the two leaders are meeting three times, starting in April, then November, December. So there's going to be lots of chance to discuss. And given they both love photo ops, I think there's a high probability that we'll see some type of sort of narrow trade deal, but something that I think will lead markets to, I think, relax it a little bit. I think will be especially positive for Chinese equities, because a lot of investors have viewed Chinese equities as uninvestable. But once we see a type of truce between the two countries, the G2 countries, I think that's going to be good, especially for Chinese equities.
You've been here many times during the year, and during those periods of tension, you talked about who had escalation dominance. Walk us through that and what the potential end game is here for these two powers.
Yeah, so escalation dominance was especially important in October. And so China has spent decades getting dominance in a host of important sectors. For example, they have over 80% share in production of electric vehicles, of drones, of batteries, of rare earths. And so they've started to weaponize this dominance that they have. The U.S. also has dominance in a number of areas. For example, airplanes, advanced semiconductors, the global financial system, access to the U.S. dollar, everything is based there. And then access to the U.S. consumer. And for Chinese leaders, particularly the elite leaders, they want their kids going to the top U.S. universities. They control access to that. So they both have areas they can escalate. But we saw in October was the big difference is pain asymmetry. Is President Xi in particular, he suffered a lot growing up. His dad was treated pretty brutally by Mao, and for a while, President Xi actually lived in a cave. And President Xi seems to think that young Chinese people haven't suffered enough, and that to some extent, pain is good. It builds character. Where President Trump, there's always another election. We're always raising money, and no tolerance for any type of pain that could lead to layoffs and bad news. So Trump folded at the end of October. And I think this is one reason to be constructive, because Trump learned a lot from that. And I don't think we're going to see the type of escalation we saw this year. And anytime we do see markets selling off on fears of escalation between the two countries, I think that's a real opportunity to buy.
Okay, so let's talk about if we get to this point with China and the U.S. where they start to, decide that there's little wins they can have for each other. Where does Canada fit into all this? Where can we start to improve our relationships?
Yeah, so I think that's important. So if you look at the sectors where the U.S. is vulnerable now, and it's a long list of sectors. So it includes, we mentioned EVs, drones, batteries, rare earth materials, steel, aluminum, shipbuilding. It's a lot of sectors where the U.S. is vulnerable. And Trump's number one economic priority is to reindustrialize the United States to reduce these vulnerabilities. And Trump realized at the end of October that he can't do this on his own. And so prior to October, he often treated allies worse than adversaries. And there's been a real change in tone. There's been a real pivot from him since the end of October. So this is an opportunity for Canada. I think Carney does need to build a relationship with Trump, and I don't think that's going so well. But to identify these potential win-wins, how Canada can help America with the challenges they face. So rare earths is a pretty obvious one. Aluminum, steel, there's issues with Algoma now. There's opportunities with steel, with shipbuilding, particular icebreakers. Canada's number 2 producer of icebreakers in the world after Russia, and it's sort of Arctic defense, NATO broadly. AI research, Canada is one of the leaders of the world through the various universities and the top people who are at University of Toronto, Waterloo, Montreal, and so forth. So there's a lot of win-wins, and I think rather than have an elbows up approach, it's more let's work together, let's be partners, let's be a trusted ally, and work on these areas.
All right, so that's trade and that's politics. The big theme, the other big theme of the year, of course, artificial intelligence. Really couldn't turn your head for a second, or at least I couldn't turn my head for a second without having to talk about it here on the show. Let's talk about some of the hyperscalers. What's the outlook there?
Yeah, so the big issue with the hyperscalers and AI in general is the amount of CapEx that they've been spending over the last year. And it's expected by the companies to be over $300 billion in 2026. That's up 6x from what it was in 2020. We have a chart up here showing that now. And it's interesting, so what is $320 billion? What does that number mean? That's over 10% of Canadian GDP. That's being spent in 1 year. If you include, and that's just 3 companies. If you included more companies, it'd be about 15% of Canadian GDP. And if you look at other big projects by the US government, the Apollo project, which ran over a decade, it's twice that amount of money. That's in today's dollars. Manhattan project, that was 5 years, it's 8 times that. So it's an enormous amount of money. And our view is that this all makes sense. AI is going to be transformational. Industrial robots is going to be the biggest industry ever, but it's going to take a lot longer than people expect. In particular, one key theme now is what's going on with OpenAI. So OpenAI is valued at $500 billion, according to its last fundraise. But it has a consumer chatbot that is probably not as good as the products from Anthropic or Google. And it's being challenged by the open source models from China. So it looks like a bit of a commodity. How is it going to monetize it? And OpenAI is committed to spending tens and tens of billions of dollars without commensurate revenues. So I think it's reasonable to think maybe in 26 or 27 that OpenAI starts to reduce their projections for spending, which takes a little bit of pressure off Anthropic, so they can reduce their projections, similar for Google and down the line. And so we continue to have strong growth numbers for AI CapEx, but less so than the numbers that we saw on the previous slide. Because I think it's going to take much longer than people expect broadly for AI to result in products that can be monetized. So we're spending all this money now, but the returns of that money, I think, are further out than people expect. So there will be a down cycle, and I don't know whether that happens in 26 or 27 or 28. You can never forecast these things, but I think that's going to be a big factor for markets.
With all that money being spent, you think there could be a down cycle? A lot of these names have done quite well too in terms of like market gains, share appreciation. People talk about a bubble. They fear about a bubble. They start talking about 1999. How do you read the situation?
So it's totally different than 99. 99, much of the spending was on telecoms and fiber optic cable. And in 1999, 90% of that cable was dark. It wasn't being used. So they were building supply ahead of demand. Right now, all of the data centers, all the chips are being used. In fact, there's enormous demand for any supply, and the bottleneck's really on the supply front. Further, the term bubble is huge. It's broad. I think it's far too binary. I think there's a good chance there's an LLM bubble, because LLM is not the architecture for the future.
The large language models,
Yes, particularly when you think about drones, EVs, or AVs, and robots. LLMs, we will have more world models, different architecture for that. And particular in private markets with companies like OpenAI valued at $500 billion, or Anthropic at $300 billion, or xAI. I think there's some real excesses there. And it may be that there's some companies in public markets who are investing a lot in data centers, but are financing this through cash, whereas Google, Microsoft, and so on, they're financing through cash flow. So I think there are areas that are probably ahead of themselves, and we could see pullbacks. But for the big hyperscalers, and a lot of the quality companies in the AI stack, they're producing so much cash, have great margins, great return on invested capital, that maybe we could see a bit of choppiness, a bit of a pullback, but nothing resembling what we saw in 2000, 2001.
Okay, so with this as our backdrop, how should investors be positioning themselves heading into a new year?
Yes, so I think first thing is stay invested. So I've been through, over my 30 years, a number of cycles. Nobody's smart enough to call the top and call the bottom. And so, for example, from 1995 to '05, you did very well staying invested in spite of the tech crash. Similar from '05 to '15 in spite of the GFC and so on. So stay invested in tech as well, but quality tech companies, companies producing a lot of cash so that they're not very vulnerable. Thirdly, I think it's important to consider diversifying outside the US. So many investors are concentrated in the US in tech, and we know that the top 10 companies in the S&P represent 40% of market cap. So there are global champions in the UK, France, Germany, Japan, even China, companies like BYD and CATL that I think should be interesting to investors. I think another area to think about is infrastructure as an asset class. It's in a secular boom because of reindustrialization as well as AI. And it's not just ports and pipelines, but all the data centers and the grid, the electric grid behind it. So I think that's a very interesting area. And I guess finally, I would say the US dollar has had a very good run. It's expensive against every currency out there. And as I think we see the US government get more involved in economic policy, as I think we see the tensions in China stay at pretty elevated areas, and certain aspects of Trump's economic policies will concern investors. I would think that through the remainder of Trump's term, I would expect the US dollar trade weighted to decline by, say, 10 to 15%.